Hey guys, it's Jerry McManus from Keller Williams here, and this is another video in our Allied Services series. What we're doing here is we're taking a look at a number of other products and services that go along in that home buying process. And today we have Marty Hancock from Acre Mortgage here. He's in the house, and we're going to talk about that dreaded thing called a mortgage that we're going out there, because for those of you that may not have $500,000 in cash sitting in your checking account, Marty's the guy you're going to need to talk to. So Marty, I got to ask you, first and foremost, one of the questions that I always hear is, do I need 20% down to buy a house?
You definitely do not.
You do not? Well, that sounds like good news. So go ahead and tell me about like minimum down payments and other things that might be associated with that.
Glad to. FHA has a 3.5% minimum down payment.
Okay.
Conventional mortgages have a 3% down option. Other programs such as USDA that allows for a 0 down. The state also has a grant for first-time home buyers. Say a little scenario where you find a person a house for $300,000. FHA requires that 3.5% down payment, which is $10,500 on $300,000. Closing costs might run them another $10,000, so you figure $20,000, $21,000. The state steps in and gives a first-time home buyer $10,000, so they're halfway home to that $20,000, $21,000 needed.
Well, that's a pretty significant step, especially like you're saying for a first-time home buyer. And when we think first-time home buyers, we tend to think, like generally speaking, younger folks, and they may not have $20,000, $30,000, $40,000 saved. But so this is an entryway for that part of the market to still become homeowners. Would you fair to say?
Exactly right. A lot of people have the income but don't have the downstroke. So this is a way to help them get in.
The downstroke, that's like one of those technical terms that I don't know if you, Mr. or Mrs. America out there, understand that, but hey, that's okay. So what about like for veterans, would you say?
VA is a 0 down program. There's not a better way to buy.
Okay.
It's a great program, and it really has no ratios.
Okay.
Works off a residual, but pretty much as long as it goes through the automated underwriting system with an approved eligible, that veteran's going to move into a home.
Okay, great. Now that's one of those things that, especially and finally after years, that awareness is there, because like I've run across people of all ages, quite frankly. They're worried about the amount of money that they have for down payment and things of that nature. And one of the other questions that I have is that, because there's some older folks like myself that they're looking to go out and buy a home, but they've sold a home. Can they take the proceeds of that sale? Say they've sold a house and they're walking with $200,000 and they're only buying a $500,000 house. Can they go ahead and just roll that whole, that net proceeds into the mortgage?
Absolutely, they can.
Okay, and then there's another thing, and I know that this is one of those things that typically when people get a mortgage, they're looking at a 30-year mortgage. Are there other options? Because I've seen, like say for the sake of argument, using that example that I was just telling you, can you make that term like 10 years, 20 years, and doesn't have to be the full 30 years?
Absolutely, you can make your own term.
Okay.
When I say make your own term, I mean in 5-year increments.
Okay, okay.
And in fact, a 15-year loan usually carries a 3/8 to 0.5% less rate than does a 30-year.
Oh, okay. So what you're saying is that if, say for the sake of argument today, the prevailing interest rate on a 30-year mortgage is 30%, on a 15-year, you're looking at maybe 5.5%, maybe a little bit higher than that.
Yes, as far as the rate goes.
Yeah.
If the 30-year fixed is running around 6, the 15 is going to be 5.5 to 5.625.
Okay, well that's good information to know, because it's one of those things that with that, and it's funny because I always say with people that are looking to buy a mortgage, when you ask for paperwork, I just say get it, then ask questions.
Exactly right.
So it's one of those things that just depending upon your employment status, whether you're a W-2, a 1099, self-employed, the paper requirements from your underwriting could vary greatly depending upon the program that you have. Is that fair to say?
Absolutely.
Okay.
Yeah. Self-employed borrowers will usually need to disclose full tax returns. Corporates, if they have them, if they're on a Schedule C, they want to see that. The typical W-2 employee that doesn't have self-employed income or rental properties can usually get away with just the W-2s for the last 2 years.
Well, thank you very much. I appreciate you taking the time, coming out with us, sharing a little bit about the mortgage process. Now, how can we get a hold of you?
Best way is my cell phone, 609-254-9054. My email address is mhancock@acremortgage.com. acremortgage.com. The website is acremortgage.com/Marty Hancock.
Okay, and you have been, now Marty, the rumor on the street is you've been doing this since I was young, skinny, and single. Is that correct?
That is correct.
All right, so Marty is nothing short of an absolute wealth of knowledge when it comes to the mortgage process, so please feel free to give him a call. And of course, feel free to give me a call, Jerry McManus from Keller Williams at 856-373-3537, and we'll see you on the next video. Thanks again, gang. Take care now.
Thank you.
Hey guys, don't forget to hit the subscribe button and notification bell. This way we can stay connected. Here's my contact information should you have any questions. Otherwise, I'll see you in the next video.